Hello, everybody. Hello, good afternoon. I am Ann O'Brien, Chief Executive Officer of CFA Society San Francisco, and it's my pleasure to welcome you to our special webinar today, How to Invest with David Rubenstein. This is the second time we've had the pleasure of welcoming Mr. Rubenstein to our society, and much has changed in the world, economies, the markets, and more since he was last here. And of course, he has a new book out, which we're keen to hear about. Today, our own Devin Banerjee, CFA, will be in conversation with Mr. Rubenstein. Devin is editor-at-large, business and finance at LinkedIn, is a member of our society, and a leading contributor to our Member Programming Advisory Council. Before I turn things over to Devin, please note that all attendees are muted for this event, but we do encourage you to ask questions through the Q&A box, please. We'll monitor those questions closely and endeavor to have as many answered as possible. It's now my pleasure to introduce Devin Banerjee. Thank you, Devin.
Thank you so much, Anne, for that introduction. Thank you to all of you for joining us for this webinar. Thank you especially to David for returning to CFA Society San Francisco to speak with us. So many times I've heard someone say, David Rubenstein needs no introduction, and then proceed to give him a lengthy introduction. I will give him a short introduction and then we'll get started. David is co-founder and co-chairman of the Carlyle Group, one of the world's largest and most successful alternative investment managers. He is a New York Times bestselling author. He's a very, very influential philanthropist and many other things. He is chairman of many, many boards, which I will not list. And I always like to humanize our investment luminaries. David is a father and a grandfather as well. So David, the new book is How to Invest, Masters on the Craft. And in putting together this book, you spoke with many investment masters who have tremendous track records of producing long-term returns for their investors. Let me start by asking you, what were some common qualities or characteristics that you find the best investors share?
Well, these investors have a number of things in common. I think it's probably true of anybody at any profession. If you analyze the best athletes or the best people who are investment bankers or any other profession, the best doctors, dentists, surgeons, they're all going to have most likely certain qualities in common. The ones I found in common with the great investors were these. One, they tended to come from blue collar or middle class families, not from very wealthy families. They tended to be pretty good students, not high school dropout types who just all of a sudden got successful in life. They tend to be pretty good students. They tended to be very good in math. They also tended to like to make decisions and like to make the final decision. They don't like to delegate that much. They also tended to be people who are incredibly interested in everything and anything, and therefore they read insatiably, not just about what they're investing in, but anything on the theory that maybe something might be interesting to them and might be help them later on. They also tended to defy conventional wisdom. Conventional wisdom would say do A, B, and C, and they tended to go to do X, Y, and Z. And that's generally the thing that made them so successful. They would depart from others in their thinking. They also tended to, I would say, share the credit pretty well and take the blame. They also have a great quality that I wish I had, which is when they make a mistake, they get over it quickly, they go on to the next thing, and they don't linger on and think about it for the next year or two, or like me, 20 or 30 years. So they tend to recognize that if you're in the investment world, you're going to make some mistakes. And since they all make mistakes, they tend to have a reasonable amount of humility. Obviously, there's some arrogance sometimes in some great investors, but generally the people I interview were pretty humble. And so those are the qualities I think they had in common.
Some of these qualities naturally are innate, as you mentioned, their upbringing or conditions that they grew up in. But for our investment professionals watching this, David, which of these qualities can be learned or honed in the course of a career?
Well, I don't want to say that you're born with certain qualities and you can't get better with you're born with certain genes. And I don't think that's true. Clearly, some people have genes that are wonderful. If your father or mother was a great professional athlete, you might have a reasonable chance of being a good athlete. It happens sometimes, but not all the times. In fact, most people in the NBA or the NFL were not the children of professional athletes. But sometimes it happens. I would say that as a general rule of thumb, you can learn these skills. You can't learn intellectual curiosity. You kind of have it or you don't, but you can certainly get better in intellectual curiosity. You can't change the nature of your birth, of course. You're born in a certain family, you can't change that. But generally, I think you can work to acquire all these skills. And I do think that, therefore, it's possible to become a great investor, not by reading this book, of course, because no one book is going to make somebody a great investor. But if you look at what these people did and how they became great investors, I don't think it's outside the reach of people who are, for example, of your society. I think it's quite possible.
Many of the great investment stories, David, tend to be around like a certain time period or one trade or one macro event. You have endeavored to speak with people who have, as I said, produced great long-term track records, which leads me to this question about the role of luck. It's always debated in the investment industry. What do you see as the role of luck in investment success, and how do you parse, like for you diligencing a professional investor, how do you parse the role of luck versus the role of these skills that we're talking about?
It's not unlike luck in life generally. I mean, people will say somebody's lucky, he or she wasn't that qualified, and look what they achieved. And there's no doubt that if you take a look at some of the most famous people in the investment world or the business world, you can say, well, this hadn't happened or that hadn't happened, they wouldn't have gotten where they are. Sometimes that's jealousy, but you can also say these people had luck. I tend to think that you make your own luck. You make your own luck by contacting with other people, being connected with other people, reaching out, trying to learn as much as you can. And when I started Carlyle, the people that I brought in the firm, I met through luck. I didn't really know them before. Had I not met somebody who introduced me to these people, these people wouldn't have helped build Carlyle. So I think by reaching out, by trying to make as many connections as you reasonably can, and by being open to new ideas and not shutting down ideas right away because you say that they can't work, I think you can make your own luck. There's no doubt about it.
Can you give us, we've spoken at a high level about some of these qualities so far, David. Can you take us, and of course I encourage everyone to read the book and buy the book. And by the way, the profits on this book, David does not need them. I believe they all go to charity. Is that right, David?
They go to 3 children's hospital: Washington Children's Hospital, Washington National Children's Hospital, Boston Children's Hospital, and Johns Hopkins Children's Center. Yes.
Fantastic. So let's drill down. Can you share some examples of these specific investors you spoke with and how a few of them have built these long-term track records of investment success?
Well, one of the most long-term ones is Ray Dalio. He built Bridgewater into a firm that is now 50 years old. 50 years old. And over that 50 years, it has produced more quantitative dollar profits for its investors than any other hedge fund. And in this year itself, I think they're up about 30% on some of their key funds. So they're still doing quite well, even though Ray has announced that he's stepping back. But Ray basically had a series of principles that he followed religiously. He's written a book about them. And I think he's a person who stuck to his principles and basically ingrained them in the employees he had. And those employees that were willing to accept the principles stayed there and did quite well. So that's an example.
What are some red flags, David, the flip side of the coin, when you yourself are diligencing investors or talent coming in the door at Carlyle or your family office? What are some red flags?
Well, when I'm interviewing younger people, I often will say, well, do you have any questions? And I've been amazed at how many times people say they have no questions. I mean, if you're interviewing with somebody, make up a question, think of a question, even if you're not curious. It doesn't sound very good to somebody who's looking for intellectual curiosity that somebody says to me, I have no questions. So that's a red flag to me. Also, if anybody ever asks, what's the compensation? That's a red flag because you're probably not focused on the right things, in my view. If somebody says, what are the work hours? That's something I don't really think there's probably a pretty good question. So I think I tend, when I'm interviewing younger people, I tend to look for people that have a record of success. Generally, people who are successful in area A, B, and C will probably be successful in some other area, not always. I also look for people that are self-starters, that people that want to be in the investment business, not because they want to get rich, but because they think that doing these kind of things is a useful thing for society and intellectually interesting. So I'm looking for people that have some ambition in life, but also I'm not looking for people that have egos that are so large that you can't really manage them. So those are the things I kind of look for, and I can spot it reasonably well, though I've made mistakes, and some people I've hired turned out great. Some people I didn't hire turned out to be great. Some people I hired turned out not to be great.
David, are great investors who possess these qualities we've been talking about, do they tend to naturally be good at other non-finance pursuits? We see so many investment luminaries try to expand their work into government or into other areas, and you've been successful in doing it. You've hired people who are now the governor of Virginia, who is now someone also who is now the chair of the Federal Reserve. So you've had success, people you've hired have had success, but are great investors naturally good at other non-finance pursuits?
As a general rule of thumb in life, I think that people who are really, really good at one thing are not necessarily really, really good at something else. It can change from time to time, but generally, if you're a great basketball player, you're not necessarily going to be a great baseball player, or at least professional, and so forth. If you're a great investor, you're often so tunnel visioned in your skill set that enable you to be a great investor that you might not be so good at something else. It happens from time to time, and clearly some people that are good investors turn out to be really good philanthropists because that's a different kind of skill set, but it's one that they can probably adapt to, and the metrics are not quite as complicated in philanthropy. So I would say, yes, it is the case that you can be good at more than one things, but the chances of it are modest. And generally, if you look at people who have been very successful in the business world, not just finance or not investing, but business world, they go into government. They don't necessarily turn out to be superstars in government. Sometimes they're pretty good, but not regularly. And then sometimes you get people who have been really, really good in government. They've been superstars in government, and they tend to go out in the business world, and sometimes they flop. And I like to remind people that because you're an expert in making widgets and you're the most successful widget manufacturer in the world, that doesn't mean you're going to be good at investing. Many people think investing is not that complicated, and they're smart enough to be able to figure it out, but it turns out it's not that easy.
The best investors also attract, capital and talent around them, and then they naturally become managers suddenly of organizations. And I would venture to say some of them, many of them, are maybe not great managers of talent of people. And yes, then they might bring in, professionals to rise up to run the firm. In your experience, David, are great investors good managers of talent?
Well, as a general rule of thumb, investors who are great are so tunnel visioned on making investments, they tend not to pay that much attention to the management side, and they get somebody else to do it. In my own case, I wouldn't say I'm a great investor or a great manager, but I had other people do a lot of those skills, so I benefited from that. But take Ray Dalio, somebody I mentioned earlier. He's a really, really brilliant investor with a great track record, but he built a very large organization. Now he had a lot of people helping him, and whether he was a great manager or not, he certainly built an organization that's quite significant. So I think in his case, he was able to do both of those things. Sometimes great investors have small organizations because they're just not really good at building organizations or managing them, and that's a different skill set.
Yeah, certainly a different skill set. More and more, the best investment track records are held by women and people of color as well. What's your take on that trend? Will it continue?
Well, I tried in my book to have a fair amount of diversity and to show people that people of color, people who are female, are actually, terrific investors as well, and some terrific ones are in the book. Clearly, this has been in a profession which maybe almost more so than almost any other profession in the United States has been a white male profession for so long. So most of the people historically who were seen as great investors were generally white males. If you go back 20 years ago or 30 years ago and look at people who are great investors, and there were books written about great investors then, there were no women in them, and there were virtually nobody of color. The world has changed, fortunately, and therefore there are people of those kind of backgrounds now, and it will increasingly get that way as those people get more opportunities and as more and more people come into the profession. But it has changed for sure.
Yeah, personally, I loved reading your conversations with some of the women in the book. Can you give us an example and kind of what you've learned from some of these great women investors?
Sure. Let me mention Paula Volent, for example. Paula Volent was somebody who was a graduate of University of New Hampshire. She ultimately was interested in art and built a little art conservation business. And as the business was taking off, somebody said, you really ought to make sure you know what you're doing in the business world. So she decided to go to Yale School of Management. And while there, she kind of walked her way into David Swenson's office and asked if she could volunteer. He said, "You have no investment background," but eventually she got him to let her work with him, and she helped him with his famous book on portfolio management. Later, she went to run the Bowdoin Endowment and increased it dramatically. And in fact, in the last 10 years that she ran the Bowdoin Endowment, its internal rate of return exceeded the internal rate of return of every single other Ivy League endowment, including Yale's. So she did an incredible job. She's now the chief investment officer for Rockefeller University.
I just want to remind our audience to please feel free to submit questions in the Q&A tab. I have many that you had sent in advance, which I will get to shortly, but please feel free to put your questions in the Q&A tab on Zoom, and I'll get to them toward the end as well. David, we've been talking about, and your book is about professional investors, people who do this for a living. But of course, everyone, or so many more people in this country and around the world, are everyday individual or so-called retail investors now. What can they glean from some of these investment legends?
Well, I didn't write the book hoping that anybody read it would all of a sudden become a superstar investor. I didn't think that was realistic. Just as I say in the book, when I read a book about golf by Tiger Woods or Jack Nicklaus, I wouldn't expect to become a great golfer. It's just not realistic. I wrote the book for three types of people. One are students or young professionals, to show them why I think investing is a very good profession, and one that actually helps our country, because you're allocating capital in the right ways. It can help our country in many ways, or help any country. Secondly, I wanted people who are not sophisticated investment professionals, but have some money to invest, to kind of figure out what they should do with it. Should they buy stocks themselves? Should they buy bonds themselves? Or should they turn it over to a manager? And generally, I think for most people, it's probably better to turn money over to a manager. And I gave some rules on what I think, how one should select a manager. But as a general rule of thumb, I'm not trying to get somebody to be a superstar investor, but to manage their money more prudently. It is amazing how hard people work to earn their money, and then sometimes they don't really spend much time managing it very well.
David, a little bit of a nuanced question for you here. Many of the qualities we've talked about that great investors have been the same over time, or kind of fundamental qualities. What are some traits you think that are like emerging or on the horizon for the best investors of the future, whether they be around technology or data fluency, things like that?
Well, I think it's very important for people to understand how to navigate, in my view, social media in ways that maybe they didn't 20 or 30 years ago. I think there's a lot of good information you can get on that, and good feedback, and also how to get information off the internet or out of the internet. It's a skill set that obviously you can delegate it, but I think being able to get information quickly that might be helpful to you, or in a thorough way, is a different skill set. I do think that the skill set of reading, and reading thoroughly, and I recommend people reading books, because I think it does tend to focus the mind, is a really important skill set that has been for before. But I think for now, because everything is in emails and everything is in Twitter kind of form, we are getting out of the habit of reading books. And as a result, I think many people are not benefiting as much as they can from the lessons they can get from reading books. So I do talk about that a fair bit. I also think that people should spend more time, investment professionals, learning how to talk better. Many people are not so wonderful at communicating their thoughts. You don't have to be a great communicator, and I wouldn't say I'm a great one, but I've tried to work on that skill. And I do think that people should learn how to improve their oral communication skills, because that can be very helpful in attracting investors, attracting a talent, and also getting people to give you information that might be useful to you.
I've actually always known you to be a voracious reader, David, and we've talked about books in the past. You've personally inspired me to try to read more. Has that been a lifelong kind of quality of yours?
Yes, I came from a modest family in terms of its income, and they didn't have the money to buy books. So I could go to the library, and every week I would go and be able to borrow, I think I could borrow 12 books a week, and I would read them the first day, and then I couldn't get any more books for another week. So I was frustrated by that, but I always liked the idea of buying books or reading books, and just trying to absorb the information as much as I can. I try to read a lot of books a year, but I have a trick, which is that I interview a lot of people about their books. And that kind of gives me an incentive, because I think it's a courtesy to kind of read the book of somebody you're interviewing, about whose book you're interviewing them about. So I try to do that. But, I also, honestly, I read books on subjects I know something about. I can get through them relatively quickly. If I had to read a book on mathematics or organic chemistry, I probably wouldn't get through it that quickly. But if I'm reading a book about biographies, politics, business, things I know something about, I can get through it reasonably quickly because I kind of know the subject matter.
So, David, let's turn, if you don't mind, to a little bit about the current environment. Many audience questions naturally are coming in around this topic. So let me start at just a high level for your take on what is happening right now in the economy, your outlook, the success or troubles of the
Okay.
Federal Reserve. As I mentioned, you hired Jay Powell at Carlyle years ago. Give us your take.
Right now, we basically, I think, are looking at a recession sometime in the reasonable future. I mean, nobody knows for certain. We're the first 2 quarters had negative growth, but not technically really a recession. I think the third quarter will probably be reasonable growth. But I think because interest rates are being jacked up so much, the inevitable result is to slow GDP growth and also to increase unemployment. And I suspect the Fed is determined to not make another mistake on inflation. I think the Fed generally would say that they misread how much inflation was going to be caused by the $5 trillion injected into the economy by Congress to deal with COVID, and also the quantitative easing impact as well. So they said they missed it, and it was transitory, they said, but it turned out it wasn't. Paul Volcker used to say that once inflation gets in the system, it's very, very difficult to get it out. It takes much longer time than you think. The Fed now recognizes that it's got its chore ahead of itself. So I don't think they're going to ease up on increasing interest rates anytime soon. The Fed cannot say publicly what I can say and what others have said, which is that until we get unemployment to about 6%, we're not likely to get inflation down appreciably. Now, what does it mean to be appreciably down? The Fed has said they want to get the inflation rate down to 2%, where it's been more or less for 25 years. But the truth is that's very, very difficult to get there. And I think the Fed, if they were honest about it, they probably would wish they had had a target of 3% or 3.5%. Because you remember when you went to college and you read economics textbooks, it was said that inflation of about 3 to 4% was the norm. It was only in the last 20 some years that we really got inflation down to 2%, and it became a problem that people worried about whether inflation was going to go to zero, and we had all those kind of associated problems. I think a 3% inflation rate is more realistic, a 3.5% even more realistic, and maybe unemployment won't have to go to 6%. Now, the Fed doesn't want to say that it wants to take unemployment to 6% because that's not politically popular to say. But if you read between the lines, that's what they're really trying to do. And I think, you have to remember the Fed has 2 missions. One is to take care of inflation and therefore the currency, but also they now have a mission that other central banks don't have, which is to worry about unemployment. But unemployment is honestly less significant in this context because unemployment affects a relatively small percentage of the population. Inflation affects 100% of the population. So their real target is to get inflation down. They'll jack up interest rates as much as they need to. I suspect 75 basis points in the November FOMC meeting and probably another 75 basis points in the December FOMC meeting, unless something changes from where economic data now suggests it will be.
And putting a few audience questions together, people are basically wondering what a professional investor is to do in this rapidly rising rate environment. So how does it change, David, relative value among asset classes, for example, or other investment opportunities at a high level?
Well, Ray Dalio famously said many times, cash is trash. And by that, what he meant was when interest rates are down to zero, putting your money in a money market fund or a cash fund, you got nothing for it. And basically you were losing money in effect because there was some inflation. Today, he would not say that. Today, he would say that cash maybe is king because you can get a reasonable return on a fixed income product compared to what you could get before. And therefore, I think fixed income instruments, particularly private credit, will be much more appealing than it was before. I think you're going to see a lot of interest in distressed debt. We haven't seen the distressed debt I would say debacle that we might have at some point when inflation, when the GDP goes down much more than it has gone down. And so you'll probably see a lot in distressed debt, which has some current yield, hopefully for people who invest in it, but also probably pretty good capital appreciation. I think you're going to see more money going into things that don't require a lot of leverage. It's harder to get leverage for real estate today or even buyouts. So if you can make investments that don't require leverage, I think that's probably going to be a pretty attractive thing as well for people.
And actually on that point, we have two questions, quite newsy questions, I have to say, about the availability of credit for private equity deals. David, what does the kind of market look like for buyout lending right now, and how do you anticipate private equity firms to adjust?
Well, private equity firms used to borrow 95% of the capital structure and put in 5% equity. That was in the 80s. Today, it's closer to 40 to 50% equity, and it could be even higher than that in some cases. So you don't have to borrow quite as much. And I think many of the private equity firms are therefore, recognizing that they're going to do a buyout. They probably can't put in too little equity. They're going to put in a fair amount of equity. There is some debt available, but it's got to be it's going to be a little more expensive than it was before, and you're probably going to have there may be something we haven't had for a while, which is covenants. A lot of the debt has been covenant light for the last few years, and you might be seeing more and more covenants in some of the debt structures so that it protects the lenders a little bit more. But I think for a good buyout at a reasonable price, I think there's still going to be leverage there. Now, what's a reasonable price? In recent years, we've been paying 10, 11, 12, 13 times EBITDA for reasonable buyouts, and I suspect the multiples will come down a bit, and they may go down even to single digits for some types of buyouts.
We have members of the society who are in private credit. Carlyle has built a very large private credit business. Do you anticipate that universe to continue growing, to kind of fill that lending void that the banks have been stepping back from for the past probably 10, 12 years?
The private credit business arose after the Great Recession that we had in 2007, 8, 9, because a lot of people recognized that if you bought, let's say, your own debt back at a discount, you tend to make a fair amount of money when the world came back. And then people began lending to people who were buying things at big discounts, and they made a fair amount of money. The private credit business now is a pretty robust one. And it's one that, as you suggest, fills the void because some banks are more nervous. They have regulatory concerns that private lenders that like in the private equity firms don't really have the same regulatory environment that banks have when they're lending money. So I think it's a pretty good business. It's a business that requires fewer people, honestly, than the private equity business. If you manage $100 billion of private equity dollars, you need a lot of people to manage that. You manage $100 billion of private credit dollars, you don't need quite as many people, and therefore the margins can be higher, and that can be helpful in some cases if you care about that kind of thing. So I think the private credit business is probably going to grow. There are people who think that private credit will be a bigger business than private equity 5 years from now. I don't know if that's true, but I do think that private credit is going to grow to a very significant size.
And speaking about debt generally, corporate debt, government debt, if you look at the charts, it's like quite harrowing, just the growth of debt around the world. Is it a concern for you? Is it manageable looking forward?
It's a big concern to me. I don't seem to be in a majority, though. To put it in context, the United States government owes roughly $31 trillion of debt. 31 trillion. When I was in the government, we had a lot of economic problems, obviously, in the Carter administration, high inflation, so forth. But when President Carter left office, I think the total indebtedness of the federal government was under $1 trillion. Now it's 31 trillion. Now, we've been able to manage that in recent years because interest rates have been essentially zero. So this was costing us, 4 to 5% of the federal budget was paying interest on the debt. As interest rates go up, we're going to be paying as much as maybe 10% or 11 or 12% of our federal budget in debt, in interest payments. And at some point, you just can't tolerate it. For example, the president's current budget now extrapolates, and it says that in the year 2050, if we don't make any policy changes and at the rate that we expect interest rates to go and so forth, and the amount of debt we have, the amount of the interest on the debt will be 50% of the U.S. budget. Interest payments on the federal debt would be 50% of the U.S. budget. Obviously, that's not going to happen, not tolerable, but it does show you that as interest rates go up and your debt doesn't go down, you're going to be spending more and more money to pay off your debt.
Yeah. Kind of related to all these topics, another audience question, which is more tail risks, David, that you see over like 1, 5, 10 years? You mentioned the recession probability, of course, but lower probability, potentially high impact risks over that horizon.
Well, there's always the risk of hubris when you make some money in something, you think you're a genius, and you put more and more money into it. And so, there could be some hubris in some areas where people get overconfident. But I'd say generally, technology has seen incredible valuations in recent years, staggering valuations. And I think some of the tech companies that have changed their life for the better are very good, and maybe their valuations will come down a bit. I think a lot of the valuations for some of the newer tech companies that don't have revenues, let alone earnings, probably are going to come down a fair bit. And so I think that's a cautionary note. A good example would be a company called Klarna. Klarna was an example. It's a kind of a payment layaway plan for buying things over the internet, a Finnish company, and it raised money at around during the height of the tech boom at $30 billion. And the most recent round, though, was at, I think, $6.5 billion, came down and dramatically. And that's because people were not willing to pay the same premium as they were before, and they recognize that the economy is going to slow down for a while. And so that's an example, just one of many examples where you have some great companies, and I think Klarna is a pretty good company, but it's not going to be able to attract the values that it once did.
So, David, let's bring the conversation back to the nature of investing and your own kind of history with investing. One of our audience members wants to ask you, what do you love most about investing, about being a professional investor? What do you love most about it?
Love most. Well, I try to say in the book that investing is not something that should be seen as a greedy thing where you've got wealthy people trying to make even more money for themselves and wealthy investors. What I try to convey in the book that investing is a noble profession in the sense that you're allocating capital in ways that can help your country by building good companies. For example, a number of venture capital investors invested in a thing called Moderna. Moderna is a company that obviously produced a vaccine that I think helped a lot of us stay healthy, or healthier than we would have otherwise been. And so the people that invest money in good companies that create jobs or create great products, I think are doing useful things. And so I think that if people are good investors, they should feel themselves, and I feel my own case, that if I invest in something that turns out to produce a good social product or a good service, I think I've done something useful. I wouldn't say that I'm the principal person that does the investing at Carlyle, but I do feel that that's a useful thing to do. And so therefore, I take a lot of pride in the fact that we've made a lot of investments over the years that have produced good companies and saved a lot of jobs. Very often, the venture capital world correctly points out that they create jobs out of whole cloth, and that's true. Private equity is not getting as much credit for creating jobs, but very often it is saving a company that might otherwise go under. By recapitalizing it, by remanaging it, and doing other things, you've saved a company that might have a fair number of jobs already. So I do think it's a useful profession. I take pride in being in it, and the reason I enjoy it is that I can see the benefit of what we do for society. There's no doubt that if you're good at this, you'll make a fair amount of money. And in my own case, I was an original signer of the Giving Pledge, and I'm committed to giving away not half, but all of my money. And I think many other people who've been good investors are doing similar kinds of things. So it's a way to kind of enhance philanthropy as well. Finally, I would say that very often our investors are pension funds that represent teachers, firemen, policemen, and so forth. And so very often when you're doing a good job as an investor, you're helping these other people that really can use good retirement savings.
Similar to my question about luck earlier, David, what about timing? Sometimes we talk about great trades in the market. Sometimes we also, on the flip side, in like private equity, for example, talk about long-term business builders where timing is less of a factor in returns. So one of our viewers says, the common wisdom is to never try to time the market. Sometimes it seems worthwhile, though, if there's a drastic regime change like these rising rates. So what's your view about timing?
Well, it depends on your definition of timing. If you watch the screens every hour by the hour, every minute by the minute, you're trying to time the tape, and you're trying to get in at the right time and get out at the right time. I think probably it's a fool's errand. If you say today, for example, probably interest rates are going to stay up for a while, and I want to recognize that I'll have some impact on society and impact on the economy, and I want to make some investments to take advantage of it, but I'm not going to sell them, tomorrow or the next day or the next week or something. I think that's not a bad thing to do. Remember, the biggest mistake that I observed in writing this book and that I've observed over the years is that the average investor makes is when the markets are going up, they jump in. And when the markets are going down, they jump out. And that generally is not a good thing to do. One, you incur transaction costs. If you're selling at a profit, you're going to have, as part of transaction cost, taxes to pay. But also, it's very difficult to time the market. And very few investors, really very few investors, can time the markets exquisitely well on a consistent basis. And I think it's a fool's errand they're try to do that. Pick a good company and stay with it for a while unless something extraordinarily unusual happens to that company, and try not to time the markets as much as you might think a professional investor or trader would do.
So we've talked about some of those shared common qualities that great investors possess. We talked about how some of them are innate and some can be honed or learned. One viewer wants to know, what's the best way today, David, for a professional investor to kind of start developing the skills to become great? What's like one actionable kind of piece of advice you might share?
Well, I would try to find an area that somebody enjoys working in. In other words, let's suppose you enjoy sports and you'd like to be an investor in the sporting world. And so, learn that area, and it's something that you would regard as interesting, but also it can be one that you can master. If you really enjoy sports, but you really don't enjoy, let's say, steel, but, trying to become an investor in the steel business when you really care about sports, you're not going to have the passion for it. And what you need in life to be successful is have a passion for what you're doing. The people that win Nobel Prizes have a passion for the area they're working in, and they don't win it by luck or just by hating the area they work on. You have to have a passion for something, and the best investors really do have a passion for something, but also the best professionals in any area have a passion for something. And I try to tell young professionals all the time, and my own children who are all in the investing world as well, have a passion for certain things and follow that passion, because if you have a passion and you follow it, ultimately, I think you'll be successful.
Another audience question, David, do you subscribe to the view that the winning companies emerging over the coming, say, 5 to 10 years will look quite different than the winning companies of the past, or will we see some of those leaders of the past reemerge?
Well, every generation sees new kind of concepts coming along. So today, for example, Amazon has been extremely successful. There are many companies that feed off of Amazon. They're suppliers to Amazon. They provide products that Amazon, in effect, sells on its website and so forth. But that might be, a good business. It has its challenges for sure. But I think the best things in the future are going to be things that are probably new or different and that we haven't thought of before. And you're getting an opportunity to be on the ground floor. If you get on the ground floor of some new phenomenon, I think it's better. Now, let me give you two that I think are challenging, and they're not brand new. But for example, the discovery or invention, depending on your point of view, of CRISPR is going to change biotech investing fairly dramatically. And there have been a number of CRISPR companies so far. They haven't yet produced gigantic profits for the people that have started them, but I suspect at some point CRISPR will see a breakthrough. Another one is quantum computing. Quantum computing is talked about, but yet no one has produced a company that's made a great fortune in quantum computing. But over the next 4 to 5 years or so, I suspect you'll see breakthroughs in quantum computing, and there'll be a lot of side companies that benefit from it, and companies that are directly producing quantum computing capabilities. So that's another area where I think you can see things happening in the future that are going to be quite attractive.
Final reminder to our audience to put some questions in the chat. You've asked some terrific ones. David, my final question for you, almost 2 years ago, you spoke to our society about your book, How to Lead. Today, we're talking about your book, How to Invest. You've clearly really nailed the search engine optimization term of how to. What is next for you? You've become a prolific author. What are you looking forward to diving into next?
My publisher, it's a great publisher, Simon & Schuster, thinks that How To is probably an attractive book title. That wouldn't have necessarily been my title, just because How To isn't probably the way I view what I wrote the book about, but it seems to be a common way to describe certain kinds of books, and maybe it's a how-to book. I am likely to be working on a book on entrepreneurship and how a part of our soul in America and culture has been I would say, doing much more to encourage entrepreneurs than you do elsewhere. Let's say, take, for example, the technologies we use. Maybe I don't need to convince anybody about this, but all of us are today. Think about this. Can you get through your day today, or any day, without using Facebook, a Microsoft product, an Apple product, Netflix, or or Google search? Can you get through your day? Many people would say no. They need Amazon, they need Google to get through the day. These companies are all American companies, started by entrepreneurs, funded by venture capitalists largely. Where are the technologies that were started by people in Europe in the last 25 years that we are now indebted to? Well, the answer is there aren't really any. And that's because I think Europe doesn't encourage entrepreneurship quite as much as I think we do in the United States. And obviously, there are some great entrepreneurial companies in Europe, and my firm invests in a number of them. But it's much harder to build a company that has a technique or a service that people outside of the Europe community use. The same is true to some extent China. China has many more entrepreneurial kind of features than maybe the European economy does and culture, but it's been hard for the Chinese companies to break through into America. Other than TikTok, not that many Chinese companies have something that everybody is so dependent on in the United States or outside of China. So anyway, I do want to talk about entrepreneurial nature of our society and how over the many, many years, we produce great entrepreneurs, and what is it about America that makes them so unique, and why entrepreneurs seem to flourish here more than elsewhere.
So I'll end with two great audience questions. David, one is a bit newsy, and the final one is a bit fun. So the first one, David, is someone is watching, and many of us are watching what's happening in the UK pension market. He says, my worry is that the US pension market, which is heavily invested in private assets, will eventually decline as those investments get marked down, probably toward the end of the year, perhaps, but maybe those valuations have not been marked properly or marked down yet. What's your take on the US kind of pension situation as those assets get marked down?
Well, there's no doubt that the great pension funds, endowments in the United States have a fair amount of money in alternative investments. And last year, they produced staggering rates of return. Universities like Washington University was up 65%. My alma mater, Duke, was, I think, up 55%. MIT, Harvard, Yale, they're all up staggering amounts of money. But some of that's going to be given back, I suspect, because there's been markdowns in the venture portfolios, the growth capital portfolios, and to some extent, there's markdowns in some buyout portfolios. So I think generally you'll probably see most of the large endowments be probably slightly negative for the year, the fiscal year, 1 or 2 or 3% down. I don't think you're going to see 30% down or anything like that. I think you'll see marks coming down such that they've given back a fair bit of what they had last year. But from what I've seen so far, the marks are going to probably take firm pensions and endowments down a few points below par, but not dramatically so.
Okay. And two more questions for you, David, because the audience is just loving having you. Somebody asks, is the world de-globalizing right now? And does that impact your investment perspective?
There's no doubt that globalization was a major part of the investment phenomenon and the society over the last 40 or 50 years or so. And what was the reason for it? Well, because it was more efficient. It's more efficient to produce something at low cost in China, ship it here, buy it here, and than it was to manufacture it here. But now, because we're concerned for security and other reasons about being dependent on medical supplies from China or food supplies from other parts of the world, we are going to probably bring more things back in the United States and remanufacture things here. It'll probably have an inflationary impact. Globalization won't go away completely. We clearly are going to still be somewhat dependent on products and services produced elsewhere. But I think the the pleasure people have had in saying how great globalization is probably gone away. And I do think it's not quite the happy word that it was before for many people. I do think it's going to be receding a bit, for at least for the time being. Now, I recognize not everybody liked globalization. Many people around the world thought globalization really meant Americanization, which, you know, was not fair. And some people in parts of our country thought that globalization meant that people in some parts of our country were going to lose their jobs to offshore manufacturers. But generally, I would say yes, globalization is taking a hit and will probably be receding a bit, not completely, but a bit.
Okay, David. And the final, it's actually two questions in one from the same person who's very curious about you, the man, David Rubenstein. He asks, how do you define success yourself? Because it differs for everyone. And also, what does it say about you that you own the Magna Carta? Because so many people probably wanted to own it and you came away with it.
Well, on success, you know, that's obviously in the eye of the beholder. As people probably know, I came from modest circumstances and got lucky in my career. And so I'm trying now to do many different things to give back society and then to and do other and hone certain skills I have. But I think success is when other people say you're successful. And to me, the only person I really cared about was my mother, who, you know, I was her only child. And so when she thought I had done something that was successful, that probably was the biggest badge of honor for me. In terms of the Magna Carta, it was an auction about 10 years ago or so. And, you know, other people could have bought it as well. I happen to think it was important to keep the only copy in private hands in the United States, because it was the inspiration for our Declaration of Independence, and it was likely to leave the country based on what I was told by the curators at Sotheby's. So it's now on permanent loan display at the National Archives, and it'll be there for quite some time.
Well, David, we really want to thank you for your time today, for returning to speak with us at CFA Society of San Francisco. We agree with your mother. I know, unfortunately, she passed away just a few years ago, but we agree that your success is a shining example for all of us. And with that, I'd like to just turn it back over to Ann O'Brien.
Thank you very much. My pleasure.
Thank you.
Thank you, David, and thank you, Devin, for such a lovely conversation. Also want to thank the attendees for some great questions. Thank you for your interest in hearing from Mr. Rubenstein. It's always a pleasure to have you. We hope to welcome you back to the Society anytime you would like to address our members.
I hope to do it in person again sometime in the future. My son lives in San Francisco, and so I get out there more, and I'm a member of some clubs out there, and so I do tend to come out. And so sometime, if we can work it out, I'll be happy to do it. But thank you very much.
Thank you. Yes, as we emerge back to in person, we will welcome you here. Thank you, Mr. Rubenstein. Thank you, Devin.
Bye.
Thank you, everybody. Have a great rest of your day. Bye-bye.
Thank you.